Hello everyone, welcome back to D Street School. My name is Shiva Gurunathan. Today we are going to discuss about the very interesting option strategy. So before we go on check out what is that strategy, how it's going to benefit us. If you're new to the channel, I would request you to watch the entire video because when you watch the entire video, I'm sure it will really helpful to enhance your trading skills. All my calls will be supported by the enough facts. So when you watch it continuously, I'm sure it will increase your trading skills. And when you implement on the market, I'm sure you will make some money on it. On top of this, during the market hours, I'm giving the free intraday calls, I mean entry and exit calls by my Telegram channel. If in case if you are required those intraday calls, don't hesitate. Please go and add yourself in my Telegram channel. Already I have given the link in the description. So please don't forget add yourself in my Telegram channel. So if you like my video, go on click the thumbs up button and share the video, because if you get benefited from my video while you sharing, others will get benefited too. So and subscribe to my channel and continue your support. Today what we are going to discuss about this entire video, I will just give the overview. First we will go and check out the volatility analysis. When I say volatility analyze, whatever the stock or index, if any particular period of time, so we will go and estimate the trading range of the stock or index. So that's we have a different types of volatility. Here we are going to check out the historical volatility. So if you already I made a separate video about the historical volatility, and I discussed about a lot of various concepts. What is the historical volatility? What is the thought process? How we go and set up the trade, like entry, exit, especially stop loss. So I would request you go and watch the entire video, but that would be in Tamil. So if you are comfortable in Tamil, go and watch the video. In case if you need the video in English, go on ping in comment section. I will made a separate video in English. So next we'll go on check out the stock and technical analysis. Why I am selecting this stock, chart analysis, indicator, and open interest concept. All the concept we will be discussing in the technical analysis. And later, what kind of strategy are we going to implement in this option trading? So we'll go on give a brief discussion about the strategy. What is our expectation? We'll go on discuss in detail. And finally, we'll go and check out the Greeks. So what are the Greeks? We have all we know delta, gamma, beta, theta. So how those Greeks going to help to set up our trade? Okay, these are the things we will be seeing in this entire video. So please stay with me. We'll be going completing this video from 15 to 20 minutes period of time. First, let me start with volatility analysis, that we speak of as a statistical analysis. Today we have selected the one stock, the name it called CONCOR. So it's a logistics sector. The previous close price for the CONCOR is 663.50. This is the previous close. And average price movement for CONCOR is 14 rupees 75, say, which means in last 1 year we pulled the data and we calculated the average price movement. So every day CONCOR averagely 14 rupees 75 say movement is giving. So this is a CONCOR APM, average price movement. So now what you're seeing on the screen is a 3 days historical volatility analysis. As I said, so if you want to know more about the volatility concept, as I said before, already I made a video for that. So I have given the link in the description. So you can go and watch it. I'm sure it will really helpful to enhance your trading skills. So let me go ahead and summarize very quickly. So what is the volatility level? So how we can go and customize this. So in order to easier understanding, so I made it as a R1, R2, S1, S2. So this is a R1, this is R2, like S1 and S2. So don't confuse, this is not a support and resistance. In order to understand very easily, just I named it as a R1, R2 and S1, S2. Okay, so how we will understand about this volatility? Let me explain. So this is a 3 day volatility, which means the next three trading session which will start from Monday to Wednesday. So I will tell you 68% confident on the 3 days. The volatility between the volatility of the Concur would be from 639 rupees to 695 rupees. So this is the range. I can tell you 68% confident the Concur will trade. The remaining 32% possibilities would be there. There will be a price will trade above this or outside of this range, either upside or downside. Let me repeat it quickly. So I can tell you 68% confidently on the three on upcoming 3 days. Concur would trade in the price between like 639 rupees to 695 rupees. So that will be a 32% chances which would trade outside of the range, either upside or downside. Still, if I want to increase my confidence, I do not want to take any chance. You can go and add up the next level. Like I can tell you, like 95% on confident, I will tell you, Concur will trade in the range between 613 to 725. So almost 100 uh, 8 points. And if you go and check the average price movement for the Concur would be 14 rupees 70 pies. So whenever you go and extend your range, increase your confident level, so its range would be extended. So this is a layman language. If I want to say in technical, R1, R2 would be a standard deviation one. R2 and S2 would be standard deviation two. So I would recommend you to go and initially stick with the standard deviation one. The range we said 639 to 695, because the average price movement would be 14 rupees 75 paise, right? So we can expect, if we can start with this range, so that would be around like 44 points. So this is the way we can understand the volatility, and I will also give the daily volatility percentage for Concur. This is not daily, actually for 3 days. It's for 3 days Concur volatility percentage would be 4.2%. This is a historical volatility. Don't confuse with that. Implied volatility is different. Usually, often you see in option chain, right? That's a implied volatility. This is historical volatility. So you can check out those level like buyer and seller strength. So as we see, our current market price would be 635. 663, sorry. So we'll go and take it. This is a level. So below 660, there will be a sellers are more, but that will be marginally higher than the buyers. When you go and see 660 level, buyers are in 56, sellers are in 73. Those those sellers are upper hand. So it will be like marginally higher than buyers. So when you go and check out on 670, 680, 690 levels, you can see buyers are predominating than sellers. We cannot come to conclusion by using these facts. So just I want you to fully concentrate on the volatility levels when statistical concept. Now we'll go and check out the technical analysis. So how its stock going to be performed. It's likely going to be a bullish or bearish or flat market. We'll go and check in the technical analysis now. Now you are watching the Concur daily chart, so you can clearly see on last previous session, inverted hammer candle is formed on the chart. So I mean, the last Friday, market opened at 671.95 price, and all the way it had gone to 690. So it unable to breach the resistance level. So due to immense selling pressure, the price closed at the level 663.50. So what we understand from this chart in daily chart, we can clearly see on Friday it formed inverted hammer. On day before day it formed doji. So the market closes previous low, I mean Thursday low. So what is the Thursday low? It clearly shows 663.20. So the yesterday close is 663.50. So all the way it touched the day before day low. So what we can expect, still we have a lot of selling pressure on upside. So what I can expect, market will come down for next two trading session. So before we come to any conclusion, let us go and check with the 60-minute chart how it looked. So as I said before, on Friday session and first 1 hour, it clear there will be a very inverted hammer candle is formed. You can see there is a very long wick on top side. It clearly says there will be a immense selling pressure. Last 4 and 5 trading session, there was a ranging market, especially on Friday. It was clear flat market. So what I'm anticipating in upcoming next 3 trading session, we can expect market will go down. So how about the momentum? So for momentum, so we can go and check on the ADX. You can clearly say it's in about 33 level, which means momentum is gaining. If market goes down, there will be a lot of momentum. So it will easily go down, which means we can, there will be a possibility we can go and see the very big red candle because of the momentum. My conclusion would be, so I'm expecting CONCOR will the CONCOR price will go down for next 2 to 3 trading session. How we go and customize our option strategy. So this is what we are going to see next. So what's our option strategy we are going to use? We are going to use put ratio back spread option strategy. So before I go and discuss about this topic, I assume myself you guys have a basic knowledge about the option, like what is call, what is put. So and you have a little bit knowledge about the Greek concept. I assume myself, even if you don't have a knowledge about the Greek concept, no issues. I will give you a quick outline on it, but I assumed you know what is put and what is call. Okay, so let's start further. So what you can expect from this strategy, put ratio back spread. As we discussed, our expectation would be market will go down. On the first leg, as we predicted, if market goes down as our wish, like we will make unlimited profit. So like I can give it an example, like this is a naked long put. Okay, so what we will have a perception on long put, we want market to go down. If market goes down, so we will make unlimited profit. Okay, like that. So in this strategy on first leg, if market go down, we will make unlimited profit. In case if market reverse, if market is performing against our perception, so what will happen? We will make fixed profit. Okay, understand? I will explain clearly. If market go down, works in our favor, we will make unlimited profit. If market works against our favor, we will make a profit, but this time fixed market, fixed profit. So what will happen in naked long put? If market behaves, if market works in our favor, we will make unlimited profit. If it go against, we will lose all our premium, right? But in this strategy, if market works in either direction, we will make profit. But when we will incur loss, if market in flat, if market works like a ranging market, flat market, we will incur a defined loss. So what we can come to the conclusion, when you use this strategy, market should not be flat. Okay, it should be in trending market, either upside or downside. So only then we can go and use this strategy, because we want to market move either upside or downside. If downside, we will make unlimited profit. If upside, of course we will make profit, but we don't want to stay market in ranging. So we will buy 2 OTM and 1 ATM. Okay, so I hope again, so I assume you guys know what is OTM, what is ITM. Okay, long put, we will buy 2 long put, one we will sell, one short put. Okay, so this is the option. I mean, this is a put ratio back spread concept. So we'll go and implement the strategy in the CONCOR. So as I said before, CONCOR current market price will be 663 rupees 55, and the put call ratio will be 41, which means buyers are dominate than sellers. 2 long put, one short put. So 2 leg, and the quantity would be 2. Okay, we'll buy a 2 long put and we'll buy 1 short put. Expiry date would be both same, 29 July. Strike price for long put would be 670, because we said as per our this concept, we should use OTM, but still, but there will be a lot of other concept too. Theoretically, we have to go and buy a OTM, but since I'm going to close this contract within 2 to 3 days, so I made some changes by selecting the site. So so actually ignore this. Okay, so I selected the in the money. Okay, I bought a long put, two contract in the money at the strike price 670. So I paid premium 12.5. So I'm expecting I'll be closing this option maximum 3 days from Monday to Wednesday. So another leg. So we sell short put. So what's our expectation in long put? Market will go down. So what would be our expectation in short put? Market should not go down either upside, or it should be a ranging market. This is the expectation of short put. So we will go and sell one short put for the same contract on 29 July. The strike rate would be deep in the money. So theoretically we will go and buy in the money, but from my analysis I selected the strike price deep in the money. So for that I received the premium 27 rupees 10 paise. So my net debit would be how much? I'll tell you what that would be, net debit. So two long put contracts, so 25 rupees debit. So 25 rupees debit. So I have to pay the premium to buy a two long put contract. So in order to sell one short put contract, I receive a premium of 27 rupees 10 paise. So we will have a net 2 rupees 10 paise. We will have a net credit. So this is not debit, net credit we will have. As soon as we implement the strategy on the market, we will have a net debit of 2 rupees 10 paise in our account, which will be the positive money. So net debit is the maximum amount you earn when market goes against your view. So according to this scenario, if market goes up, so the maximum profit we will earn would be 2 rupees 10 paise. This, which means, as I said before, this is a fixed profit. So we need to now we know when market goes down, we will earn profit. When markets goes up, we will earn fixed profits. So if markets in range market, only then we will incur loss. This is as we know. So but in what range we have to know, right? In what, if market stayed in a particular range, we will incur loss. So we have to know what would be the range. So that is the range. So between 652.10 to 687, if price closes between in this range, we will incur loss. So the maximum loss would be 17 rupees 90 paise premium it incurred. Again, I will tell you, this is the range we will incur loss. If price closes within this range, we incur maximum loss of 17 rupees 90 paise, maximum loss. So during the price range, the loss could be curbed, but the maximum loss we incur at 17 rupees 90 paise. So minimum profit, the net debit 2 rupees 10 paise. If market goes with our favor, unlimited profit. So what's our target? So I'm expecting 640. As we know, we predicted market will come down. At which level it will come down? So I'm expecting 640 because the contract will be expired on coming Thursday, right? So before that, I'm expecting the price will touch the 640. The units will be 1,563. This is a predefined unit. If you make 1 rupee profit in premium, so you are making 1,563. So you can, I'll give you example. If the net debit would be 2.10, so your profit would be 2.10 into 1,563. This is your maximum profit if your market goes against your prediction. So I hope you understand this concept. Okay, so let's go on deep further. So as we know, we initiated a two long put strike rate would be 670. So what is the delta, gamma, theta, vega? So the Greeks are very important, which plays an important role in our option premium. So these are the delta for the two long put. So actually we had a delta around like 1.63. I mean, sorry, 0.63. Since we bought a two quantity, so our delta would be minus 1.28. So short put delta would be 0.936. So overall delta position would be minus 3 points, minus 0.317, which means every 1 rupee fall in underlying asset, premium will increase to 0.317. Let me explain what is delta. Delta is a rate of change of, capture the rate of change of value in the premium. For example, if underlying move 10 rupees, move down 10 rupees, so what would be the premium increase? Simple, 10 into 0.317. So 10 into 0.317, like a 3 rupees 17 premium will increase. So we know when premium increase on long put, so we will make some money. So overall delta portion would be minus 0.37. So gamma is a capture the rate of change of delta itself. When underlying moving 10 rupees, delta will capture how much premium will increase, but gamma will capture how much delta will increase. So this is a gamma duty. So theta is a actually option is a depreciation asset. So every day the option will lose its value. So how much it will lose? Theta will give answer. So as of now, for long put, every day 80 paise will lose on the premium. So for example, if premium would be 10 rupees, tomorrow it will come like 9 rupees 20 paise. So time will eat your premium. So for Vega, what is the implied volatility in this strike price? So we have 0.26 implied volatility. If 1% of volatility increase, so 0.26 paise will increase on premium. For example, volatility increased by 10%, so the premium will increase 2 rupees 60 paise. So if we lose the volatility by 10%, it will decrease the premium by 2.60 paise. So this is a Vega. So what you have to understand here is you can check out this chart. So this is the place you can incur loss. This is the level I gave you. If market goes beyond 687 rupees 95 paise, you will have a fixed profit of 2 rupees 10 paise. So if market goes like a 290, I'm sorry, 690, 695, better you will go and close the position by getting a profit of 2 rupees 10 paise on your premium. If market comes below 652, you will incur unlimited profit. Like when market goes down further, you will make unlimited profit. So here our target would be 640. So you will earn 12 rupees on your premium at the time where price reaches 240. So 12 rupees into 1,563 units, almost you'll be earning 18 to 20,000 rupees if price reaches 40 levels. So this is I wanted to convey the things. I hope so you understand this concept. If you do have any questions, please ping me in the comment section. I will revert back to you. As we analyzed, the current close of the price would be 663 rupees 50 paise. So all we need to 10 points between the lower breaking point and the current market price. Since we have an inverted candle appeared on the chart, so we can expect minimum 20 to 25 points go down, and moreover average movement of the price would be 14 rupees. So let us see how this stock performs. So I gave a 3 days duration for the price target. So let us see on Monday how it's going to be. So these are the premium which I calculated basis on the Friday close. So when market opens on Monday, so there will be a little differences on the premium because of theta. Saturday, Sunday, and the theta will reduce the option premium value. So let us wait and watch how its option going to be perform on Monday. So I hope I made you understand very clear. As I said before, if you like this concept, if you like my video, please do subscribe to my channel, and me thumbs up and share the video. So again, we will come and select a different index or option, and we'll come up with a different option strategy on another video. Till then, bye from Shiva Gurunathan.